Thanks for joining us today on Market Call. I'm Morella Fernandez. John Zechner with us on the show, chairman and founder of Zechner Associates. He'll take your questions on North American large caps. Here's how to reach us. Call 1-855-326-6266 with your questions. You can email them in as well. marketcall@bnnbloomberg.ca. Good to see you.
Yeah, you too.
Let's talk a little bit about the stocks that have been bouncing around, gold and energy primarily, with Iran in the headlines. Where are you in both of these?
We're underweight gold in the recent run, but I mean, you still got a pretty decent gold position. I think what people don't have full concept of is how big gold is in the index. I think it's around 15%. We're not carrying that big a weight, sort of in a high single digits, and about a market weight in the energy side. And I did a little selling into the energy names yesterday. These things don't tend to last long periods of time, and it's been a good trade, certainly over the past 2 months. So.
Okay. We get a lot of questions, I'm sure you do, about software stocks now and the future of those. Where are you these days in tech?
Tech, we're still underweight. We got underweight earlier, but I'm looking to get back in, Morella. It's I think we had the AI scare, and then people worried about the capex, and capex can continue, and then you've had this SaaS apocalypse kind of thing. People worrying about software getting eradicated or replaced over periods of time, and those are, maybe legitimate long-term worries. But what stock market investors tend to do is to take a narrative and expand it, fully to the end, and they've created a lot of selling. I think the bigger problem for the sector right now is it wasn't a very, what I call a crowded trade. Everyone was, new money had come into the market the last couple of years. Equity weightings were at all-time highs in the U.S. A lot of that money went into the tech names. Then you had all this passive money, which went into the indices, which had gone up to, I think, about 35% weighting in the tech names. So you got a very, very heavy weighting with a lot of quants and sort of passive money that's sort of not paying as much attention to fundamentals. So as these things tend to do, valuations exceed on the upside, and now you're unwinding that trade. And I think the chance is you can, miss it on the downside as well. So I don't think you've taken away the good long-term story and the valuations and how much these companies contribute to overall economic growth and certainly to corporate profit. So I'm more looking to add. But having said that, Morella, history teaches you something, and one of the biggest mistakes I made in 2001 was buying into the pullback too early. When tech started to pull down, I think when things were down 30 to 35%, we started buying back into some of the names we'd owned and sold, and they ended up dropping 70 to 80%. I don't think this is going to happen this time around, because I think it's a better fundamental support and a better stories and better cash flow generation than anything else. But in the meantime, like I say, they could overshoot to the downside, and you're seeing it. You see good earnings reports the other day, like a MongoDB or somebody like that. What happens? Stocks down 15, 20%, right? In the follow-up. So.
Yeah, investors are being very picky about where they're putting their money as far as tech goes. Okay, let's take a quick break. We will line up the first questions for John Zechner, Zechner Associates. Again, he's taking your questions today on North American large caps. Back in a moment. Welcome back to Market Call. We're going to start with an email from Gary today who says, what does the guest think about Brookfield Corporation? John Zechner is our guest today. John, do you own any of the Brookfields?
I don't own any of the Brookfield names right now, Morella. And actually, I can't think of when we would have last had them. My issue a little bit with them is I like operating companies. And these things are a little opaque in the structure, the cross-ownership. It reminds me sort of, the group sort of grew out of the old EDPR, the Toronto version of the side of the Bronfman family back in the 80s with He's International and a lot of Brascan and companies like that. And this sort of Brookfield almost is similar to that with the ownerships in real estate and private equity and other things. So when you're playing a real mix, and then I look at the pieces, well, the private equity, I don't really know what's in there as much, and I don't know if I'd want to invest in that through a public company like this. Real estate, it's still early. I'd rather play some of these things directly, the money management. So the pieces I'm not enthralled with, and this holding company structure to me is, 70s, 80s version, and I just not a big fan of it. So I know a lot of people love it, and it's a massive weight, but we're off. If I were to be in any of the names, it'd probably be the Brookfield renewables.
Oh, why is that?
Just because I think the renewables are better potential growth longer term, and it is more of an operating company on that one.
Okay, let's go to the phone lines. And Rob's on the line. He is in Calgary. Hi, Rob.
Hi, thanks for taking my call. I'd like to hear John's opinion on Algonquin Power, the chart showing a bit of a recovery over the course of the last year or so. So I'd like to know if he would buy, sell, or hold this stock, or does he prefer another player in this space? Thanks again for your advice, and have a good afternoon.
Thank you for the question. What do you think of Algonquin Power?
I probably take that latter comment that you said, taking someone else in the space. I mean, Algonquin's had a very tough couple of years, disappointments, and then they did that massive acquisition of power, coal-generated power in Kentucky that really backfired on them, and that drove the stock down. So, they're crawling out of that hole. He's very technically, the stock looks a little bit better, but I just find other names in the sector have a better growth story, better valuations. I'd be more inclined to own Capital Power, just because the electricity generation base in Alberta, better growth. They've done some more recent acquisitions that are stronger. Or Northland Power, we sort of talked recently about renewables and what they've been doing. That stock got hit pretty hard. So I'd probably take other names in the sector.
Okay. Rob, I hope that works for you. Let's go to Ben, who's on the line in Kingston, Ontario. Hi, Ben.
Hi, good afternoon to both of you. John, welcome again.
Yeah.
John, I'd like your opinion on Apple. Do the fundamentals attract you at these valuations, and are you invested, or are you going to be investing for immediate future? I would like your opinion. Thank you very much. I'll listen to your answer. Thank you.
Thank you for that. We talked a little bit about the movement away from tech, and you mentioned you are looking at some now to maybe get back in. Is Apple one of them?
No, it's a valuation story. Because what I'm looking at more is a GARP, like a growth at a reasonable price kind of valuations in the tech sector. And, I can get into a bunch of names there in software where you're looking at trading at 10 to 12 times earnings. Apple, you're still looking at at least, even with the pullback or the stagnation a little bit, a high 20s earnings multiple for single-digit growth, effectively. I mean, they do a lot of engineering, to make those earnings per share look better than that, and buybacks and everything else. I mean, you can't argue with the long-term growth story. They're the operating system for over 70% of mobile devices in the world, and that's, giving them obviously a lot of clout in terms of the applications and everything else. They have not brought AI into the structure very well. That is yet to come, and maybe they'll succeed at that. But it's a behemoth, but and they're dominant, and they generate a lot of cash, and that's probably a better story than some of their competitors who are spending too much on capex right now, which they're not doing. But on the other hand, the valuation just hasn't come back. I can see a whole lot of other names, even in the Mag 7. I look at NVIDIA, Microsoft, Alphabet's rallied a little bit, but still you're talking about market multiples on those kinds of names, whether you're still paying a premium for Apple. So bottom line, no.
Okay. Ben, I hope you got your answer there. Let's go to Elliot in Hamilton with a question. Hi, Elliot.
Good afternoon. I'd like to add an American Financial to my RRSP, and I'm looking at JP Morgan or Citigroup. Both are down from their highs. Would you buy either or neither today? Thank you
for the question. Citigroup.
It's funny. I was doing that same exercise recently as well, because I had been out of the U.S. financials completely, and I sort of looking on the pullback. I'm looking at some of the names, and Citi probably came over to the top of the list. What Jane Fraser is doing in the restructuring, has been fantastic there. I think they're on a valuation basis, it's still the cheapest, and they're improving that. They're taking up their ROE. They've still got the global financial structure. So I would prefer that one. JP Morgan is still a premium to everything else. I mean, I guess they've earned it and they've delivered on it, but I'm the type that I'm not a fan of paying these big premiums just for what they've done historically. I want to see going forward whether they can continue to deliver on that. So I'd take Citigroup ahead, and if I was doing a second name, I'd probably lean to Bank of America on that.
Why did you pull out of American Financials? You said you pulled back?
In financials generally, I mean, I'm just not comfortable with, they'd rally. The interest rate structure in the U.S. I don't think will be that favorable. I'm still questions about the U.S. growth going forward in general and with the financial institutions. And financials in general, I think there's a lot of optimism around them, but I'm a little more concerned about incursions into their growth from electronics and other things. So I'm just, it's been a big bullish area for everybody. And up here, the banks have delivered. But like I say, the valuations are at the high end of the historical range, and I don't see the same earnings growth. And yet you've got all the economic sensitivities. So,
okay, let's get to John then. John's in Toronto. He's got a question. Hi, John.
Hi, I'm John from Toronto, and I'd like your guest views on the future of copper, specifically Freeport-McMoRan, or if he has another situation that I could consider.
Okay, thank you for the question. John, would you chase copper right now, considering how much it has run up?
No, because I'm looking at the global copper inventories, and they're quite extended right now. So there's been a bullish story there, obviously, with the long-term electric generation and the need for copper and all of that, and the fact that you have sort of a paucity of mines coming on globally, and everyone sort of runs over budget, it costs more, so there's been supply side shortages. But now the inventories are starting to build up again. China has has sort of stepped back as much of an aggressive buyer as they've been. But in terms of the names for playing going forward, Freeport has been sort of the largest global player in copper for a period of time. But boy, Teck Resources on this merger with Anglo is looking like one is going to be a major copper player in the world. They're going to be consolidating some mines. So I think, Teck Resources, and get a Canadian play out of that might make sense. And a valuation basis, it probably looks better than some of them as well, without a lot of the geopolitical risks that you get associated with some of the other players.
Got it. Okay, Teck Resources might be something to consider. Let's take another quick break. We'll be back with John Zechner of Zechner Associates to take your questions on North American large caps. Back a moment. Welcome back. Let's go to Gordon on the line in Victoria, BC, with a question today. Hi, Gordon.
Good morning. Rick Kruger, an alumni of the Exxon management culture, lured out of retirement. 3 years in, he's transformed Suncor operationally from also ran to best in class. The knock on Suncor has been its relatively low reserve life. I believe that Rick is going to want to address that by way of acquisition, and that will be the cherry on top of the cake. What do you think?
Yeah, no, he's done a fantastic turnaround. I mean, Suncor had lagged for years, and the valuation, I mean, they're only just now in the past year sort of coming back to the highs they saw back in 2014. So it's really been quite a tough slog for them, just because, the oil sands projects are difficult. They're construction projects, construction projects initially, and they're sort of in industrial products, almost operations. So, they're great cash generators once you get them working properly, but, that took a period of time. So he's delivering on that. Yeah, the reserve life, I mean, generally in oil sands, the reserve life is pretty long. So I don't know that they need to go out and make any immediate acquisitions, but there's always, I think, consolidation in the sector is continuing to come. So it wouldn't surprise me if they do something.
Okay, let's move on to our next caller. Then Mark's in Ottawa with a question. Hi, Mark.
Hi, John. Your thoughts on Tourmaline versus Thomson Reuters? Would you have a preference? Thanks.
Okay, thank you for the question. Apples and oranges here.
Yeah, they really are. They're not. It's not in the same area at all. I mean, we own Tourmaline now. I bought it recently. Thomson Reuters, we don't. I always found the valuation just too excessive. I mean, you were paying sort of a 20+ multiple of operating cash flow for single-digit growth. Now that's corrected with the way the stocks pulled back pretty dramatically, and so it might be looking a little bit more interesting down here. But Tourmaline, I mean, Mike Rose has been probably the best operator in the energy space in Western Canada for a number of years now. They continue to grow, by the drill bit as well as by some acquisitions. They continue to be inside buyers of the stock. Good play on natural gas as well. So I like Tourmaline. It's one of the more expensive plays out there, but the rest of the group has sort of come up to meet it. So relatively, it's not as expensive compared to the rest of the group as it's been, and yet they continue to deliver on all the parameters. So
okay, let's move on to our next caller. Then Dennis is in Cochrane. Hi, Dennis.
Hi, thanks for taking my call. My question's on Whitecap. With all the turmoil in oil, Whitecap pays a great dividend monthly. Where do you see this one going? Thank you.
Thank you for the question. We'll pull up Whitecap in just a second. What do you think?
Yeah, I like it. I kicked myself. We sold it not that long ago because it sort of, hit our shorter-term targets. But I like what they're doing. Most importantly, they stole Varen, or the old Crescent Point Energy when they bought it, I guess, a year and a half ago. Because I thought that was just turning around at a great assets, and Whitecap got it at a very good price. And now they're seeing the benefits of bringing those assets into their own fold. combining them with their existing light oil base in Western Canada. So, they continue to deliver good management, good operators, valuation isn't particularly excessive, and it's also in a smaller field of, Canadian independents that are, more focused on light oil. So it's I kick myself a little, like I say, for selling it now, and I sort of, we may see ourselves back in the name at some point.
And it's 5 and change dividend, something like that?
Yeah.
Yeah, so good dividend there. Okay, let's go to Ghulam in Toronto with a question. Hi, Ghulam.
Hi there. Good morning to you both. My question is on Propel Holdings. I bought a little bit when the stock dropped a couple of months ago, and it's still dropping. I don't know whether I should buy some more to average my cost down, or is that not a good investment?
Yeah, that's interesting because it's they had a pretty bad fourth quarter earnings report in the last couple of days we saw, and the problem with some of these alternative lenders, private equity lenders, that what we're seeing right now is just the the quality of their loans is popping up. The reserves are having to go a lot higher, and then they're having to write them off, and that's always been the issue. I mean, the banks sort of take the best credits and leave everybody else to fight over. So you've seen stocks like Go Easy and Propel and all come under a lot of pressure recently. So it's a bit of a minefield. I don't know if I'd advocate sort of jumping in and buying more at this point until you start to maybe see stabilization in the loan loss provisions, or what the loan book looks like a little bit more. So the alternative lenders tend to take higher risk loans, ones that the banks sometimes don't take. And that obviously increases your risk, particularly getting into times like this where you may have a little bit more economic risk in Canada.
Okay, so if you have it, just hold it, but not necessarily.
I would not throw more money after it at this point.
Got it. Okay, let's go to Garnet in Peterborough, Ontario, with a question. Hi, Garnet.
Hi, thank you for taking my call. I just want to comment that this is a great program. I've listened for years, and thank you for all the stock advice. My question is with regard to particularly holding in TD Bank. Do you think TD Bank is still a long-term item, or would you be looking at other banks?
Okay, thank you for the question. A lot of people got into TD because it had a long way to go to close the gap, right, after it got dinged in the U.S. It's closed some of the gap now. It's at 134. Would you buy in today?
No, I'm not buying any of the Canadian banks right now. And you're absolutely right. And we were buying it sort of when it got beaten up, and it lagged everybody else because of the problems they had in the U.S. And they've obviously corrected some of that. The problem I have with the Canadian banks right now is just simply valuation, trading north of 14 times forward earnings. About a 3.5% dividend yield, 2.2 times book value. These are right at the top end of historical ranges. Maybe earnings will continue to deliver because they've had a few tailwinds. Obviously, capital markets have been strong. Mm-hmm. Underwriting in Canada has been strong. Loan loss provisions have not blown up like maybe some of the expected, and some of the economic worries of last year have not come to fruition. Maybe because these tariffs have not been as negative an impact.
And on again, off again as well.
And on again, off again. But having said that, I have a hard time, looking to pay those sorts of valuation. I don't see a lot of upside. I see other areas of the market getting more beaten up. So if you hold the banks, I don't say you have to necessarily rush out and sell them, but it's 30% of the index up here. I don't see any reason to hold 30% banks in the portfolio. I see better opportunities elsewhere, and they're not even great income stories anymore compared to telecom and some pipelines, utilities, things like that. So.
Okay. Let's take a quick break, then we'll come back with past picks from John. That's coming up next. Time now to have a look at past picks from John from July 24th of 2025, so about 6 months ago. John, at the time, he chose Rogers Communications, RCI. .B on the TSX at 47.06, and now to 54.73, so 16% upside, total return of 18%. You briefly mentioned telecoms in the last block as where you see some money coming back into. Are you still holding Rogers?
Yeah. The telecom stocks are still in the penalty box. I mean, that's compared to the rest of the market, that's an okay return. It's not great necessarily. And remember last July, I think that at that point, the Jays were in 5th place in the division.
They were benefiting from that.
Yeah, they were not. The fact that they make the playoffs was not happening at all. But No, I mean, the telecom stocks, I like the area. It's good dividend yield, relative to cash flow. I think trading over 6 to 7 times. These people have been worried about the debt levels, competition, but I think, that's sort of broadening out now that, Quebec Ore has brought in Freedom Mobile. You got the 4 players now, and I think the wars have effectively slowed down. These are effectively infrastructure assets on communications. I think they're underappreciated. So, no, I like the sector still, and in this name in particular, just, because they will monetize, I think, their, the sports franchise money. Because the value of sports franchises globally are going up massively. And obviously what they have, I think they need to bring in an additional player to highlight what that value is, generate some cash, and then free it up for the rest of the business.
Any concern about the mobile business, the fact that we don't have the same immigration policies, and so they're not getting a lot of new customers necessarily?
And that's been one of the biggest drags on them, Morel. That's exactly right. Because, who doesn't have a cell phone? So, your biggest source of new growth or new subscribers was immigration, students, things like that, and that's gone away. So they got to increase the average user, but they will be able to incorporate AI, I think, as well as almost any other industry group as well in terms of customer knowledge and sort of getting more out of that. So I think that's a positive for them as well. And they continue to bring in the assets, from the Shaw acquisition and consolidate them and get costs brought down that. So it's a good long-term story, cheap, and it's get a dividend yield at the same time.
Okay, let's get to your next past pick, B2 Gold, a BTO on the TSX from last July, 479, and now to 757, so 58% upside, say 59% total return. Price of gold continues to do well this year. Have you held on? Did you trim in this?
We just sold it recently, and I moved the money actually into Barrick for the North American assets. This lagged a little bit. It's playing some catch up. The problem for B2 Gold was their biggest production is the Fekola project in Mali, and that's over 50% of their annual production. And with the problems that obviously Barrick had in Mali last year, so that made everyone worry and give it a discount multiple, even though they're good global operators. They're bringing on Goose in Canada, which will start to replace some of that production, and you take it away some of the geopolitical risk. But Goose is having a few startup difficulties as well. My worry a little bit, Morella, for some of these companies on the geopolitical side, with gold now around 5,000, it's suddenly a lot more profitable business, and it may attract the attention in West African nations and others like that, hey, this is a much bigger pie now than it was. Maybe we should change the rules. We want a bigger piece of it, exactly. And then you saw what happened with First Quantum in Panama, and obviously, and that think of that as geopolitical risk area. Never mind compared to Mali or something like that. So I'd rather focus more on the North American, at least Mexican. So Torex, Barrick Gold, Agnico Eagle are 3 core holdings now in the gold.
Do you feel like the problems are over for Barrick in Mali?
Well, not necessarily. Well, they sort of solve the main problems, and you still have some global assets there. What I like is that Barrick's sort of splitting into a North American and a foreign, and I sort of think at that point, if once you get that, I'd be more likely to get out of the foreign portion. I think that the North American will probably get a premium valuation.
Got it. Okay, let's get to your last past pick from July, Pembina Pipelines, 50-60 at the time you recommended it last July, now to 60-13, 19% upside and 22% upside here. Are you still in pipeline?
Yeah, we still are. It was just, that was what we were looking for in the portfolio. Safe plays, defensive, relatively low valuation, particularly compared to, TC Energy or Enbridge is a little bit cheaper. I thought better growth potential. And you get, at the time, you're getting a 5% and change dividend yield. I think that's come down a little because the stock's risen. So it's delivering what we wanted. We still hold it. It's just, part of that. That's what I like in the market right now, is just looking for some ballast so we can get some income generation. You're not paying a high multiple. You don't worry about the downside of stocks pull back as opposed to some of the, the higher beta sectors. So it did what we wanted it for us.
Okay, let's take another quick break. We'll get to more phone calls and emails when we come back. Welcome back. Let's go to John. He's on the line in Milford, Ontario, with a question today for John. Hi, John.
Hello. John, I'd like your thoughts on Bank of Montreal going forward. I guess you already answered my question. I've owned them so darn long, I probably was buying them in the 8 PE ratios, and I'm up 2 to 3 times my money. I just can't give up my dividends. What's your thoughts?
Yeah,
Thank you very much. Bye.
That's a good point. I mean, it is a good dividend. I'm not saying, rush out and sell all your banks right now. The problem I remember about two to 3 years ago when they bought Bank of the West, and then they had a couple of, I think, like 4 quarters in a row were just miserable numbers. The loan loss provisions went up, and it's like everybody absolutely hated BMO, and and now it's more than doubled from that price. So I think at the time it was trading around 100 or something like that. And now everyone's on the other side of the boat. They all love it. It's got a premium valuation, and that's why I'm sort of more leaning into no. I'd be selling that and maybe just looking for some laggers. Someone phoned earlier about maybe some of the U.S. financials are actually looking cheaper than the Canadian financials. Maybe even look at the life companies. Manulife, Sun Life have not acted well lately. You got decent dividend yields there too, and we obviously talked about telecom and utilities.
I was going to say some of the telecoms are good for that.
That are if you're strictly in it for the dividend yield. So I'm just a little concerned that the valuations are leaving less upside for the banks right now.
Okay, let's go to JC in North Bay with a question. Hi, JC.
Hi, I'd like to ask John about MDA Space. Reported solid earnings today, and talking about the spin-off with 49 North. What do you think about it? Is it still got some legs left?
Yeah, we still like it. It's, loved it all along. I mean, it just had a brutal year last year because we know back in August that, they lost the EchoStar contract and its stock dropped pretty sharply. You can see it on the chart there. And then a month later, everybody was worried they're going to lose the Globalstar contract. It was another $1 billion plus, and the stock went into the low 20s. And, that second case scenario did not come about. Globalstar is basically Apple's entree into satellites, and they're not giving up on that, no matter what Elon wants to do with Starlink. So that's not happening because that's what happened with EchoStar. It got sold to SpaceX, for the spectrum. So I think MDA is well positioned on the LEO, the low Earth orbit satellites going forward. They'll get other contracts, I think, from what we're seeing on the Canadian fiscal spending side, particularly on defense and space. So that's growth going forward. I brought up some other international contracts as well recently. I think one was in South Korea and a few others. So they're getting additional business as well as there's some in the U.S. But I mean, for the U.S., who knows? You don't want to take any chance that it's a government contract for anything in the U.S. going to go to a Canadian company right now.
I was going to say, do you feel like international players will go to Canada for that stability as opposed to some of the U.S. players?
Oh, and people are sort of making their bets. You see it all over the place, whether with England and India, whatever, Canada and India. Everyone's redoing these agreements because of the U.S. has become a less reliable trade partner, and they're going to redo these things. But at the same time, the U.S. is very circumspect about, giving any major contract to anyone outside of the U.S. So that, they don't have anything particular with MDA that's at risk from that. It's not a Globalstar, but that's an Apple call.
Yeah. Let's get to Murdo then on the line in Niagara Falls. What's your question today?
Hi there. I just wanted to ask what your thoughts are on strategy.
I run for the hills on it.
Tell me a little bit about it.
Well, strategy basically is a play on Bitcoin. I mean, the whole thing Michael Saylor does is they've bought Bitcoin, they hold it, and then they lever up, they issue debt to buy more Bitcoin. So effectively, it's a holding company for Bitcoin. So it's a levered holding company. And when the strategy was working, when the whole concept was working, the stock was going higher, and it was trading at a premium. When you looked at the market cap of strategy, it was significant. I think at one point it was a multiple of the value of the Bitcoin that it held, and yet there were effectively no other assets. So those things just, worry me completely. So I like, if you're brave enough to play cryptocurrencies, don't play the most levered way of doing it, which is strategy. So, go and buy the Bitcoin ETF or something like that if you feel so inclined. I mean, I don't play the cryptos at all right now. I still don't understand what the functionality, utility ultimately is down the road of blockchain technology and the incorporation by companies as a general. It's to me, a highly speculative asset. You think I'm going to take a speculative asset and play it in a totally levered way? I guess when things are going up, it works. But as you see, when it doesn't work, how much is the stock down from its peak? 75, 80%?
Yeah, the risk is there. Okay, let's get to Darren on the line in Ottawa. Hi, Darren.
Thanks for taking my call, folks. My question today is about Baytex. I owned it since the pandemic, and just wondering if it's got more room to run.
Okay.
I'd say no. We owned it through the pandemic as well, and it certainly acted well. It's always a levered, sort of higher cost, more of an oil sands play. It diversified well in the past couple of years, but the balance sheet was still fairly stretched, which was a problem, and they were a higher cost producer. So when oil started last year, they were going down, towards $60 and below again. They were very much at risk. Now they sold their Permian assets in the past year, so now they've got the Canadian, mostly heavy oil assets, so you don't have that upside anymore. They sold them last year, so they probably could have done a little bit better with that sale, but the stock ran higher, so you've done that. You're left with the Canadian assets now at more of a premium valuation. I think there are other things in the sector that look more interesting. We talked about Whitecap earlier. I think, Cenovus. There's other names, Tourmaline, that we've talked about that I think I'd rather play than Baytex up here, which is sort of a levered heavy oil. Well, it's not as levered as well. They've taken the financial leverage out with obviously the sale of the U.S. assets.
Just wondering if you're playing energy in any way as associated with the data build-out, AI, the data center build-out.
Well, to do that, I think you want to play more on the natural gas side. That's why we've got ARC and Tourmaline and plays like that. Then, the electrical generators and, some of the engineering construction companies and all of that are probably more direct, better play on that.
Okay, so that's where you're going for the data center building.
Yeah, like Capital Power, something we talked about earlier. So.
Got it. Okay, let's take another quick break. We will come back with more questions for John Zechner of Zechner Associates. Again, he's taking your questions today on North American large caps. Here's the number to reach us. We're back in a moment. Welcome back. Let's go to John on the line in Grand Prairie. He has a question today. Go ahead, John.
Yes, I see you just made a comment on it. Capital Power, buy, sell, or hold. Thank you.
Okay, thank you for the question. You like Capital Power, I think.
Yeah, I'd buy it in more. And we already own it. The earnings were out yesterday. I was looking at the numbers. They were sort of, in line to a bit of a beat.
It's down today, though.
Is it down a little today?
It's down a little today.
Yeah. Well, I think that's, some of the energy-related names are down today. So that may have sort of got caught up in that. They did that great acquisition in the sort of the Pennsylvania corridor last year, and they're getting increased prices on that acquisition as well. And, the data center build up in Alberta, obviously they're front and center for that for some of the smaller scale production. And they've beaten in the last couple of quarters, and stock's still trading only about 8.5 times. Forward operating cash flow, good. You got a dividend yield at the same time. So I like it as a good, safe utility play in a growing area. It's sort of ticks off all the boxes.
Okay. And you said you'd buy more at where it is today.
Yep.
Got it. Okay. Let's go to our next caller. Nyron's on the line. He is in Scarborough, Ontario. Hi, Nyron.
Oh, hi, Marilla. Thanks for taking my call. Question for John on Manulife. This one, I noticed 6 months ago, Manulife was down in the 42 range, and then it make like a $10 run up to 52 at the beginning of February, and I see it's making a decline now. It's down to about 46. If John can throw some light what's happening with Manulife right now, I'd appreciate it. I held the stock before. I used to hold it for the dividends, but I don't know what's going on right now. If John knows something else.
Okay. You mentioned you'd get into insurance.
Yeah. You can still hold it for the dividend yield. It's so strong. I think there was a little disappointment in the last quarter, sort of some of the U.S. operations. They still got the growth coming out of Asia. And I've talked earlier. I thought the valuations on a lot of the Canadian bank stocks are looking pretty excessive right now relative to historical trends. Whereas the major life insurance companies are sort of right in line with where they've always been. So you're talking about a company trading, about 11 times forward earnings, decent dividend yield, sort of some global growth prospects. So I'm fine to own Manulife in here. Like I say, I don't know specifically why it pulled back recently, and with the market in general, maybe some money shifting to banks, or maybe it was just disappointment, I think, with that last quarter and some of the U.S. operations. But I think, the story is still intact.
Okay. That was for Nyron. Let's go to an email from Beth. She says, I would greatly appreciate your guest assessment of open text. Is it a buy, hold, or sell at this time? What is the upside potential over 12 months? and what is an alternative if you're looking that way. Okay, so open text having some of the same challenges in that space, and also a change in leadership, I believe. So what do you do with something like open text?
Yeah, we don't own it right now, and it wouldn't be at the top of my list of software companies to look at. As you say, all the valuations have come down, so OpenText used to stick out as a sort of a cheaper play within the sector. It's not, you can no longer argue that. Organic growth is somewhat non-existent, like 1-2% kind of thing. So you're not really getting the applications growth. The balance sheet was a little bit stretched because of acquisitions that they've done over the past couple of years as well. So I don't know. It doesn't really ring the bells in terms of what I'm looking for in the software sector. There's lots of other names. I would look to the U.S. A Salesforce, Adobe. Up here are going to talk about Constellation Software. There's Lightspeed, the cheap stock that's growing. There's other things that look more interesting to me. And obviously, the king player in software that has come down a lot up here is Shopify, which I'd rather own for the longer term growth.
How are you determining the software that you are staying in? Why not OpenText and why some of the others?
Well, that's still got to unfold. That is a tougher call. Which software systems are most at risk from incursion from AI? And I think a lot of these ERP systems that are sort of built into companies are going to be very hard to replace. Like I'm not going to start doing my ADP payroll on AI necessarily, and other functionalities. You're not going to start doing your taxes by AI. So, those companies that have those specific integrated software programs, I think, are less likely to lose it. So, where the risk is, we'll have to find out over time to develop. It will incur into software and point, but some will sort of bring it in and incorporate it into their overall structure and use it more effectively as well. So this will play out. The stock market has done the thing of, like, say, the narrative run to the end line right away, which is it'll eradicate ERP software, application software. It won't. It just, there will be pockets that get hit a little harder. Guys with no organic growth right now, I'd be a little more concerned about.
Okay. All right. Let's get to another email from Stu in Kelowna. Hi, John. He says, can you please give your comment on Boralex as a long-term investment? Tell me about Boralex.
Boralex is alternative energy or renewable energy, effectively, and it's mostly offshore wind. A lot of based in France. Some in elsewhere in the world as well. Some in Canada. The earnings just came out recently. They got growth projects on the go, and there's always risk with your growth projects going forward. So the valuation, though, it's probably 9 times operating cash flow. I like that. Decent dividend yield while you wait. And think about these projects over time too. Once you get through the capital costs and once they start operating, like let's face it, your input costs are non-existent.
Yes.
Because you're not paying. Exactly, it's free. You got a free input there. So I like the idea of what you build on these renewable structures over periods of time. And once they're up and running, I think they're going to be massive cash flow generators. So subject we were talking about that with wind and other these things, you can't necessarily count on it quarter to quarter. But I just like what Boralex is doing, what they're delivering, and really they're not a big U.S. play because let's face it, the hardest place to do renewables right now is the U.S. because they just don't want.
And do you feel some of that has passed over to Canada? The disinterest in renewables at this time?
No, not to the same degree. That is everything to do with, the comments coming out of the White House and how that drives policy. We're not seeing the same thing up here or anywhere else in the world. Nobody else is taking, there's things like trade and renewables and all of that. It's only the U.S. that is going down that road, and they're going down it solely.
Got it. All right, let's take a quick break. We will get to new top picks from John when we come back. Join us tomorrow for Market Call. Ryan Modesto will be on the show, CEO and Portfolio Manager, I2I Capital Management. He'll take your questions tomorrow on North American stocks. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now for new top picks from John. We're going to start with Constellation Software, CSU, on the TSX. We talked about the hit to software. Constellation Software has really gone down. Are you looking at picking it up? Have you picked it up already, and why?
Yeah, no, we've been buying it. And this is stock that I've never talked about on air or about owning or sort of really been positive on for years. I sort of stayed away. The valuation I always find excessive because it was, minimal organic growth, and it was all acquisition oriented. And I thought, your acquisitions over time are going to get more difficult to do, and why are you going to pay 25 times operating cash flow for that kind of a business? I mean, I was wrong as it went up, and then in the end, when the story sort of did fall apart a little, but then Mark Leonard left, so people worried about the architect of this whole move is gone. So what's it? But now I'm turning around and looking at it, trading about 12 times operating cash flow. It's still got the same strategy in place. I don't think Mark Leonard leaving has really changed that. You've built up too big an organization.
But is it a viable strategy moving forward?
Well, I think it's even more viable right now, Morella, because a couple of things is obviously with the missiles bombs you've seen in software. I think there's a lot of companies that are going to be looking to move off. I think the valuations will come down for guys who are acquisition oriented, have strong cash balance of the free cash flow. I think that works very well to Constellation's advantage. At the same time, one of the bigger competitors for them had been, private equity out there. Private equity have their own concerns, so your competition to buying these assets are not there. So I expect over the next couple of quarters, we'll start to see their acquisition activity, pick up dramatically. With the vertically, market software that they've always focused on, that will continue to be an area. In terms of the Mark Leonard leaving, I mean, yes, he was the guy who sort of created all of this, but in the end, I mean, Steve Jobs, when he left Apple, looks like with Tim Cook, sometimes you just need a different person can steer the ship when it gets into a different direction or a different stage of their growth. And I think, right now they've got enough of a structure, they can move it going forward at a much cheaper multiple.
Okay, that was for Constellation Software. Let's get to your next pick. North American Construction, NOA on the TSX. This is a company that does sort of mining and construction both in Australia and Canada?
Yeah, and it's funny because people don't know this company that well, but the ones who know it sort of know it for what it was. It was sort of the original construction company for all of the oil sands projects in Canada, which is why in North American Construction, Fort McMurray base, so they did all of those major oil sands projects that were developed there, and that's what they were. And that business, no new oil sands developments are coming in, so the stock came down for periods of time because there's no growth. But people don't realize these guys have diversified phenomenally well over the last number of the years. They're in construction internationally. They should change the name of the company for one thing. They got big Australian operations, a lot in the mining business as well. So and within all these engineering and construction companies, which are trading 10, 12, 14 times operating cash flow, these guys are trading about 4 times operating cash flow. So it's cheap. I think it's a still growth area. It's unloved. It's maybe really more unknown. I think it offers potential upside, and it's just not the same business it was. That oil sands business, I think, is about 10% of the revenues now.
So this is a slower growth, a longer term hold.
Yeah.
Got it. Okay, let's get to your next pick. Microsoft on the NASDAQ. We talked about the picked over Mag 7. A lot of them are down. You like where Microsoft is right now?
Yeah, and when you can get a company like this at a market multiple, you want to jump on that. And I had issues for a while just because when it was trading at 35 times forward earnings, you sort of got a little concerned. But the last quarter, Azure, their cloud is still growing, about 40% annualized rate. They still got over 80% of the operating systems for desktop and laptops in the world. I'll give you a quick classic example. But we're a small company. A couple of years ago, our in-house servers, we were needing to replace them for our network, and it was going to cost me about $60,000 or something like that. And our sort of IT consulting guy said, or you could go to the Microsoft cloud, which was a couple of $1,000 conversions. We didn't replace our servers. I went to the cloud. Suddenly, storage, memory, cybersecurity, access, everything else they look after at a much, much reduced cost, and it's seamless. Of course, now I'm part of the Microsoft ecosystem.
And you won't leave it.
And I won't leave it, exactly. Yeah. And I think that's what these guys do, and they own it. And I think they will bring AI into the product portfolio better than anyone. No, I think they will be at the front end of monetizing it, and you're getting it all for a market multiple.
Which they've already done. Copilot's in your email for us, and that's the way they're going to bring it to people and get them to rely on it.
Exactly. Yeah. So.
Okay, Microsoft it is. That does it then today for Market Call. John Zechner, sir, thanks for coming in. Appreciate it.
Thanks, Morella.
And thank you for joining us today for the show. We will see you back here again tomorrow.